No jargon, no fear, just the first steps. If investing feels confusing, intimidating, or like something other people understand and you somehow missed the class on it, that means you are exactly where most beginners start. You do not need to know everything to begin. You just need a clear first path and a way to avoid the mistakes that come from fear, not from lack of intelligence. Most beginners are not behind. They are just unstructured. A lot of people stay out of investing for one reason. They think not understanding it means they are not ready, but waiting until you feel fully ready usually means waiting forever. Investing is not something most people understand first and then start. It is something they begin to understand because they started, carefully, with simple tools and small amounts. Clarity often comes after action, not before it. The first lesson is not knowledge. It is permission to begin simply. The biggest myth beginners believe is that investing is only for people with a lot of money, insider knowledge, or a high tolerance for stress. None of that has to be true. You do not need to predict the market. You do not need to pick the next miracle stock. And you definitely do not need to turn your phone into a trading terminal and stare at charts all day. That is not investing for beginners. That is confusion dressed as ambition. Real beginner investing is usually much calmer than the internet makes it look. Hey, I'm Kira. By the end of this video, you will understand what investing actually is, what you need before you start, the simplest, beginner-friendly options, the biggest mistakes to avoid, and the exact first setup that makes investing feel manageable, even if right now you know almost nothing. Because the goal is not to impress anyone. The goal is to begin safely and keep going long enough for the process to matter. And that usually starts with making the subject feel smaller, not bigger. So let's define it simply. Investing means using money to buy something that has the potential to grow in value or produce income over time. That could be stocks, bonds, funds, or other assets. The key idea is this: instead of all your money just sitting there, part of it goes to work. And over time, if you do this well and consistently, that money can start growing beyond what you personally save from your paycheck. That is why investing matters. It gives your money a job beyond storage. But before you invest a single dollar, you need one thing first: stability. This is where beginners should slow down. If you have no emergency fund, high interest debt everywhere, or money that you will need next month, that money should probably not be invested yet. Investing works best when the money can stay untouched long enough to survive normal market ups and downs. You do not invest survival money, you invest surplus money, and knowing the difference protects you from panic later. This step matters because markets move. Sometimes up, sometimes down, sometimes in ways that feel dramatic, even when they are normal. If you invest money that you cannot emotionally or practically leave alone, every market drop will feel like a personal emergency. That is how beginners panic, sell too early, and decide investing is not for them, when the real issue was weak preparation. Preparation does not guarantee comfort, but it prevents chaos. Once that base exists, the next beginner question is simple: what should I actually buy? For most beginners, the best answer is not individual stocks. It is broad, low-cost funds like ETFs or index funds. Why? Because they let you own a large group of companies in one purchase instead of betting everything on one name. That means more diversification, less stress, and fewer chances to get wrecked by one bad pick. Think of an index fund or broad ETF like buying the market in a simple package. Instead of trying to guess which single company will win, you buy a slice of many. For a beginner, that is powerful because it removes a huge amount of pressure. You do not need to be brilliant. You need to be consistent. Diversification is one of the best ways to be less wrong while you are still learning. And being less wrong consistently is often far better than trying to be spectacularly right once. The next thing beginners need to understand is time horizon. If you are investing for something a year away, the strategy should be different from investing for 10 or 20 years. The longer your time horizon, the more useful growth assets can become because you have more time to ride through volatility. Time is not just a detail in investing, it is one of the main tools. It gives good decisions room to work and bad timing room to matter less. This is why regular investing matters more than dramatic investing. Beginners often think the goal is to make one brilliant move. Usually the goal is the opposite. Make many boring, correct enough moves over a long period. Invest regularly, keep costs low, stay diversified, avoid panic. That sounds less exciting than stock picking stories, but boring is often exactly what works. In investing, excitement is frequently overpriced. You also need to know the difference between investing and gambling. Investing is a process with risk, patience, and logic. Gambling is chasing fast returns because you are bored, desperate, or impressed by someone else's screenshot. If the thing you are buying is something you cannot explain in one plain sentence, that is a warning sign. Beginners should not start with complexity. They should start with things they can actually understand. Confusion is not a strategy. Another beginner mistake is thinking you need a lot of money to start. You do not. Many people begin with small monthly amounts. What matters first is not scale. It is the habit. A small amount invested consistently teaches you how markets feel, how your platform works, how your emotions behave, and how discipline actually looks in real life. Small beginnings are not embarrassing. They are intelligent. Tiny recurring investments can teach bigger lessons than waiting for a dramatic amount to appear. And yes, there will be terminology. Stocks, bonds, funds, diversification, risk tolerance, expense ratio. But do not let words scare you. Most of the language becomes much less intimidating once it is attached to a simple action. A stock is just a tiny ownership piece of a company. A bond is basically a loan you are making. A fund is a bundle. Diversification means not betting everything in one place. You do not need a finance degree to understand those ideas. You need calm repetition. This is also why beginner investors should be very careful with advice coming from people who make investing sound like a performance. Fast wins, secret plays, guaranteed returns, aggressive leverage, complicated trading systems. This is usually content, not a beginner plan. The more urgent and glamorous the pitch feels, the more cautious you should become. Real investing for beginners should feel understandable enough to repeat next month. So what does the first real setup look like? It can be almost stupidly simple. Open a brokerage account. Choose one broad low-cost fund. Decide on an amount you can invest without stress. Automate that amount monthly, then leave it alone long enough for the system to work. That is not the entire universe of investing, but for a beginner, it is a very strong start. Simplicity is not weakness here. It is protection, and protection matters more than sophistication in the beginning. And yes, you will still feel uncertainty. That is normal. Starting to invest does not mean fear disappears. It means you stop letting fear make every decision. The market will move. Headlines will get dramatic. Some days your account will be up, some days down. Beginners need to know this early. Movement is normal. Volatility is not always danger. Sometimes it is just the price of being in the game. Emotional calm is part of the skill set, not a personality trait you either have or do not have. One more important thing, do not confuse learning with endless preparation. You should absolutely understand the basics. But there is a point where research becomes fear-wearing glasses. If you have an emergency fund, no urgent need for the money, a simple diversified option, and a small amount you can start with, then you already have enough to begin version 1. You can learn more while the habit is already in motion. That is how most people really become investors. Not by finishing the theory first, but by building confidence alongside action. There is also no rule that says your first investing plan must be perfect. It just has to be functional. Beginners often put too much pressure on the first move, as if one decision will define everything forever. It will not. What matters more is that your first setup is safe enough, simple enough, and repeatable enough to continue. You can refine later, but you cannot improve a plan that never started. So here is your move this week. Build your financial base first if it is missing. Then choose one beginner-friendly investment account, one broad low-cost fund, and one monthly amount that feels sustainable. Do not aim to feel like an expert. Aim to become someone who has started, because investing gets less scary the moment it stops being theory and becomes a system, and systems are easier to trust than moods. Most people do not avoid investing because it is impossible. They avoid it because it looks more complicated than the first step actually is. The first step is simpler. Stabilize your finances, start small, buy broad, automate, and stay in long enough to learn. That is how beginners become investors. Not by knowing everything, by doing the right simple things long enough for them to matter. That is the full picture. No jargon, no fear, just the first steps. You do not need to know everything to begin investing. You need enough stability to start, enough simplicity to stay calm, and enough consistency to let time help you. Subscribe if this helped, and I'll see you in the next video.